Good evening, everybody. I'm Tony Goldstone, and I'm delighted this evening to be joined by Dan Foy, who is a financial planner from Forvis Mazars. So hopefully, if all the technology is working, you should be able to introduce yourself. Just turn your audio off, or is that me the echo? Two ticks, Dan.
Yeah, bear with me one sec.
Do you want to introduce yourself, Dan?
What was that? Sorry, Tony?
Do you want to introduce yourself, Dan?
Yeah. Evening, everybody. As Tony said, my name is Daniel Foy. I am from Forvis Mazars Financial Planning, and I'm one of the associate directors. But most importantly, I'm one of the financial planners who covers the medical profession. So I'm based out of Manchester, but we cover the UK, and then we have advisors up in Scotland as well. So we are fully in the depths of the NHS, and obviously looking forward to digesting what came out of yesterday's budget.
That's brilliant. So thanks very much, Dan. So what we'll do is we'll switch over hopefully to the slide deck, and I'll bring up your slides, and then if you can just give us an overview of the budget, and then hopefully we will after you've done that, just do a bit of a recap of what everyone's talking about at the moment, which is the RPSS. I'm
Yeah.
afraid it's going to be a bit of a bit like the pandemic with kind of next slide, because I'm having to advance the slides. But hopefully I will do do an okay job. So I'll hand over to Dan and let him talk through the budget issues.
Thank you very much, Tony. Yes, so as I say, kind of first things first, I guess, there's a lot to digest from yesterday. Some of it, I think, slightly underwhelming, where not a lot's changed for better and for worse. And some of it was a little bit of a surprise, I guess, and we'll cover some of those things as we go through. And in particular, kind of how they, just exactly how they reflect on the medical space in particular, and the problems and things for some of you guys on the call to be thinking about. So, Tony, if you just want to move it along, next slide, please, as Chris Wee would say. So, our kind of the key things really that we want to cover off today. First and foremost, we've got what we've called the cost of doing business. Now, this obviously is something that relates wider than just the NHS, but ultimately, as the main headlines that came out were the national insurance increases, and we'll touch on that in a little bit more detail, and I guess the cost of employment for people, and that's one of the biggest stories coming out of the budget, really. So we'll digest that a little bit and look at how that impacts on general practice in particular, and also on wider NHS. We'll also look at another one of the big changes was capital gains tax, with a couple of tweaks added in there and a couple of changes, and again how that's relevant to the NHS and the medical profession. For some of you who maybe have private practices or property or shares in partnership buildings, for example, that'll all have a knock-on impact. So we'll digest that a little bit. And I guess the third of the three main points is inheritance tax, and how that's changed, how that landscape's changed, and what that might look like, and how that impacts on different professions. I think one key thing in the inheritance tax point is looking at how it, one of the key changes is how it's impacted on farmers rather interestingly. So someone asked me the question today: who's had it worse, doctors or farmers? So we'll look at the comparison between the two and quite what's gone on there, and put a bit more understanding on that. A couple of other changes as well, but then obviously we'll leave plenty of time for questions. And a bit of a Q&A and a bit of a chat through as well, Tony, with anything that you've got. Any questions? So if we want to move straight through, Tony, into the next slide, cost of doing business. As I say, what this really is looking at is some of the changes that have come about primarily through the cost of employment, and the cost of actually having staff, rather crudely. That's kind of one of the points that we're going to be looking at here. So if we go straight past that into the next slide, it highlights some of the changes that you can see. So national minimum wage and national living wage increasing from the 1st of April 2025 for people aged 21 or over, for people aged 18 to 20 and 16 plus and apprentices. You can see there some of the increases, 6.7% increase, 16.3% increase for 18 to 20-year-olds, and 18% increases for under 18s. Some rather large numbers there that we've got increasing, and those standalone are pretty big jumps. And I think for a lot of employers will be stumbling blocks and will be hurdles, and will make people seriously think about their workforce and the makeup of their workforce. When you add on to that what's on the right hand side of this slide, the cost of national insurance, an additional 1.2% of national insurance, so up to a 15% rate. However, the biggest thing that comes out of national insurance for me is the drop from the threshold. So you don't now start paying it from 9,100, you start paying it from 5,000. That is kind of equivalent to the old, what people would refer to as stealth taxes. You've increased the rate and you've reduced the threshold. You've got a bit of a double whammy here. And that's quite a significant impact. And just looking at some of these numbers, we've been running through some numbers and some calculations. And if you've got a staff member on 16 hours per week on national minimum wage, that staff member in the NHS, so it could be maybe receptionist or in a practice, or some junior staff members who maybe are at that national minimum wage level, that staff member now costs you an additional £1,450. That's a 13.2% increase on what they were costing you between the first, ultimately, kind of where we are now and where we're going to be in April 2025. Someone on 40 hours per week on national minimum wage, again, £2,862 increase. That's 9.8% more that staff member costs you. And when we look in the NHS, obviously we've got things like banding increases. We've just agreed 6% pay rises across the board. All of that's now been agreed, and then what's being dropped in, you're now paying people more, and now that employee who costs more, you're now having to pay more national insurance as well for it. So this is quite a big impact on workforces, and I think we were discussing it, how that's going to impact, particularly on general practice. The cost of staff members is going to be huge. 30 again, I've run some numbers here, but if we look at kind of a £31,200 per week salary for a staff member, so that's 40 hours per week on £15 per hour. That staff member costs now an extra £880. If that's your kind of average workforce and you've got 30 staff, it's an extra £26,000 in costs that your business has got to find in general practice at a time when one of the biggest, I guess, problems is the funding for general practice, and how those calculations are made, and what funding is given per patient, per head, and I've seen, obviously, ASMA have written today straight back in terms of there needs to be urgent remodelling of that calculation. I think that is primarily the first response that comes out of these national insurance questions. So this is a huge change, I think, and certainly one that I feel will hit general practice in particular hard as it stands. Obviously, kind of the wider NHS is covered under the public sector, and you can see within the budgets that they've done, they've kind of provisioned this change will raise 23.7 billion, 4.7 billion of that will go straight into public sector increased costs for national insurance. So a lot of
and I think that public sector point is key, isn't it, Dan? Because obviously GPs, are businesses, but they're operating in the public sector, so they're going to need assurance really, really quickly that all of this is going to be fully and properly funded, because even before this budget, every week you go on Twitter or whatever and you see that practices are handing back their contracts because it's just not financially viable anymore. So I think the quicker that assurance gets out there, the better. But anyway, I'll let you carry on, Dan, and talk.
No, absolutely. I think that's one of the things that's been requested because it's mid 25. The part of the budget they announced a review of NHS funding. That, however, looks like it could be a while down the tracks and is certainly something that's going to be welcome. Final point on there, they rather interestingly announced that the employment allowance is now available for all businesses. Everyone will qualify. However, that doesn't include public interest businesses, which covers GPs. So again, even the increased employment allowance that they give, so for businesses where your employer's national insurance is under 100,000 previously, or is now going to be, that threshold will be removed. That doesn't qualify for GP practices. So even the allowance that they've given and the way that they presented that was slightly misleading, because again, that's something that GPs I think are looking for and general practice looking for, and isn't going to be found, isn't going to be forthcoming. Just moving on to the next slide, because I think that there's enough to be said on that, and we'll kind of park that there. One of the next things that we'll focus on is capital gains tax. I'm conscious I'm whizzing through this quickly, so apologies for that. We'll come back to kind of questions and anything anyone wants elaborating on. But the next kind of point that we'll look at here is capital gains tax. And if you look, just moving on to the next slide, there's a lot of numbers on here, but there's a couple of key things that I really want to focus on, because this might not be relevant to everybody. And ultimately, capital gains tax is paid when you dispose of certain assets and have made profit on those assets. There was a lot of rumours in the run up to the budget, and as I say, this is one of those where you go slightly underwhelmed by that, because there was talks about capital gains tax being increased to match income tax rates, so going as far as 40%. And what they actually did was moved it from 18% to 24%. And there was almost a sigh in the room when they did it. All that press and all that anticipation that people had come up with, and they decided to move it to 24 and just make it the same as what residential property is. So slightly underwhelming increase, I think, in that sense, in just the capital gains tax rate. Those rates have gone up immediately for capital gains tax. So anyone who is selling a property that is potentially in progress, not yet gone through, you will be paying the higher rate, because that's effective as of yesterday.
That's an investment property rather than your own property, Dan.
Yes, yeah. Main residence obviously is exempt. So yeah, any kind of rental properties or other properties, whether that be, and this is again one of the key reasons really is we look at capital gains tax, and in particular in this space, it might be something that's either shares that you've got if you've got a share portfolio, or it might be rental properties, or it might be property that you hold or a share of the partnership practice, or it could be shares that you've in an investment business or a private practice, potentially if you've got a limited company with some private practice. So there's a couple of ways that you could be exposed to capital gains tax, but ultimately I think the general message of that one is the rate going up hasn't gone up anywhere near as far as was rumoured. The one thing that they really have done in this is the business asset disposal relief, which is what you see there as BADR. That's a relief for people selling shares in qualifying businesses. So if you own more than 5% in a qualifying business, in an unlisted business, when you sell those shares, you can qualify for, it's what was known previously as entrepreneurs relief. So a lot of people might have certain trading businesses, again, kind of private practice, and you might sell that, you might dispose of that for whatever reason, and you would previously have had £1 million of gain that you could make within there, and that'd be subject to 10%. That's going to increase from April 25 to 14, and it's going to increase from April 26 to 18%. cue the mad rush of people trying to sell and dispose before April 26, even April 25. So I think when we looked at the budget, we expect there to be something that creates a window of opportunity for people. This is it. This is what people are going to say, well, can I do something like this sooner, to try and ultimately secure that 10 or even 14%? Because if you've got the full £1,000,000 and paying 18% rather than 10%, it's a significant uplift. It's an extra £80,000 in tax that you would pay.
Yeah, absolutely. And I know some medics definitely use this, don't they? So they might, inverted commas, live off their NHS income and then kind of keep money in a limited companies,
Yeah,
with the ultimate plan of disposing at it, at retirement or whatever. And so
yeah,
that 10 essentially to 18% is a big deal, isn't it?
yeah, absolutely.
It's a very big deal because obviously, the situation you described there might be fine for people that are kind of closer to when they wanted to kind of end that. But if you're, in your 30s or 40s and we're a long way from, planning on retiring or whatever, it's gonna be a bit of a rethink, isn't it, on how you structure all of that.
Yeah. I think generally what I would say as well is capital gains tax here actually, when you compare them to income tax rates, particularly in the medical profession, capital gains tax rates still look pretty attractive. And so it might not be that these rates are enough to completely shut down the whole landscape that we've lived in, with kind of private practices, limited companies, investments in limited companies, that kind of approach. It does just mean that people need to think a little bit harder about how they do it. So, spouses, exemptions and transfers, and when you're disposing of this, exactly how you use your allowances is going to be really key, I think, for people. And this comes slightly, I'm trying not to jump too far ahead, but a lot of the changing planning that people will do on capital gains tax is probably driven more by the changes in inheritance tax than it is by the changes in capital gains tax. So I'll come on to that in a second. But ultimately, it's one of those things where people, for example, the disposal of share in the practice property, people would have, typically you would have had 3 years to get rid of it at 10%. Whereas now you might well see a lot of partnerships trying to rush through the disposal of the property and for retiring members. And how quick can you do that? Can you get that new funding in place and the transaction done before the 6th of April 25? If you can, the retiring member will probably be very happy about that, because there's a rate there. So previously, again, you were looking at how do we manage the interest rate? We'll knock it back. We'll wait to get more lending until interest rates come down. Whereas actually for the exiting member, you're probably going to be putting a little bit of pressure on to say do it sooner.
Yeah.
So a bit of a fine balance there for people to manage. Okay, I'll come back to kind of that in a second if that's okay, Tony, because so if you just move on to the next slide, there's a couple more points on here which I'm just going to touch on slightly. In particular, the middle one, because when we do have people who are doing private practice through limited companies, the capital gains tax rates mean having that increase as it is means it's probably still a good way of going for some. For a lot, to be fair. What you now have is because of the employer's national insurance, what that really does is it makes salary sacrifice even more attractive. For people, and that's something where when you're looking at how you take money out of your limited company, salary sacrifice arrangements, employer pension contributions that aren't going to be subject to the 15% national insurance contribution rate, that's certainly something that is going to become more and more attractive again for people, where possible. Obviously, that does require annual allowance. And we'll touch on pensions in a second, but that does become more attractive. One key thing with this as well is how you actually structure them. What we will see now is a lot more companies using complex structures. How do you structure your company to be able to do this? So if you just want to move on there, Tony, because we'll come back to a little bit of that. The next kind of point on this, and the third and final, I guess, key change really comes down to inheritance tax. And there's some of this which is relevant, and some of it which is slightly not relevant. But I just want to give you an example as to how this has changed. And what you'll see on the next slide is when we look at inheritance tax, current thresholds frozen until 2030. The one big change that they've made, and this is where I say, have farmers had it worse than doctors? I don't. I'm not going to make that statement. I'm not going to make that call. But agricultural relief, what that used to mean is for anyone who died owning agricultural land, they would qualify for 100% exemption and relief from inheritance tax. So they could pass on ultimately the farmland to the family without inheritance tax. That relief is being reduced to 50% from 6th of April 2026. That's a huge change because how many farms have a significant kind of level of cash that can fund these bills? You see here the example of, and it's the same for business relief, for trading businesses. That shares in a trading business used to qualify for 100% inheritance tax relief. However, that's been changed. So the £1 million limit remains across both reliefs. However, thereafter, instead of 100% relief, it's a 50% relief. So effectively 20% IHT. If you look there at just some rough values and pay no attention to the numbers, but what you can see is the difference for someone who has £20 million business or farmland or wherever it might be. They've gone from paying no inheritance tax on the 5th of April 2026 to suddenly having a 3.8 million liability. Now those numbers are quite high level, I know that, but you can see the difference between dying on the 5th of April 26 and dying on the 6th of April 26. It's a huge number. And the reason why this is particularly relevant is, again, for those who are doing private practice through a limited company, your shares in the limited company before, what we used to say is the best thing that you can do is hold the shares in a trading business. And that might still be true because it's 20% IHT rate rather than a 40. But what you now need to be doing is thinking long and hard about how are we actually going to cover this liability if anything were to happen to us. Because there is a significant liability, and that this has really changed the landscape, I think, of businesses. If we think of family businesses where they've passed it on generation after generation after generation, that was all done on the basis of there was no inheritance tax to pay along the way. So you could pass these businesses on. Family-owned businesses now, and how you do multi-generational family businesses, is going to be very difficult because somewhere along the line, you're going to have to raise a significant level of cash to pay the taxman, and that's usually within 6 months of the date of death. How many businesses have that level of cash floating around? So there's quite a lot to digest in this, but ultimately it's a huge change in inheritance tax for people. And what it does mean is if you are operating through limited companies, you really need to be planning earlier, because there are things that you can do. You can still gift away shares. You can manage. How do you do what's known effectively as growth shares? There's different opportunities where maybe your family members have different share classes, and you manage the inheritance tax position through that. But this all needs to start much earlier than it did before, because primarily before the advice was you want to die with the shares in the trading business. Now, not so sure. So when you're thinking about your private practice, you need to be on the front foot with this. It might be as simple as you have an insurance policy that provides the liquidity to pay the tax bill. That's your simplest solution. And the business can pay for the premiums as well. But doing nothing could well lead to quite a big change and quite a big problem for people in this sense. Again, you might still die with it because of CGT and CGT not being payable, and you get the uplift on the base rate on death. So ultimately, when you pass on that asset to your family members then are treated as having paid for it on the day that they inherit it at the value that they inherited it, not the day that you got it. So you might still go down that route. But again, it leads to not having significant assets held within a business, or if you're doing it, your business needs to be structured right. So again, how do you take the money out of the business? Well, with national insurance as it is, you're probably going to look down the pension route. But the next slide on the Tony, which you've got on, sorry. Pensions brought into IHT from 2027. Pensions have always been treated as a very much an anomaly, but I'm not 100% sure why. That's I don't think this is really, although it's a huge change. We discussed it earlier, didn't we, Tony? It seems to be a sensible change. Why were pensions not included in the value of your estate? Why could you just pass on your pension tax free? Because what people were doing was not spending the pensions to live off. And this relates a lot to defined contribution pensions. So all of you who have NHS pensions, this is a huge issue for the defined contribution space, and a huge change. Everyone who sat with NHS pensions, put your feet up, relax, and enjoy the drama, because it doesn't really impact on you too heavily. However, as I said, there will be people out there who will have defined contribution pensions, and we've talked about that. I've led you through employers' national insurance means don't take it out of the business's salary, put it into pensions because of inheritance tax. But now inheritance tax relies on pensions as well. So you kind of got this fold where you've got very few places to navigate to here. So you really need to be thinking carefully about how you do that. This is a particular problem for people, and there's significant rules. Pensions pre-age 75 and defined contribution pensions in particular can still be quite tax efficient. However, post 75, what happens is you pay inheritance tax on death, and the government have now confirmed that when the beneficiaries want to take everything out, they will pay marginal rate of income tax as well. So if you think of someone inherits a £100,000 pension, they pay 40% IHT on it, they receive £60,000. Their beneficiaries then want to take that out, and they're higher rate taxpayers. They then pay 40% on £60,000, which means they end up getting, out of the £100,000, they get £36,000. £36 to the pence to the pound is quite a low return for people. And so what it's going to do is navigate people away from stockpiling pensions and spend it during retirement, which is what the pension is for. But it will ultimately mean, I think one of the things that we said, that I kind of mentioned earlier, more people will be spending a lot more a lot earlier because they don't want to die with pensions anymore. And quite how that impacts on our care system, people choose to save, leave money behind for care provisions. They might now be put off by the fact of the inheritance tax and the tax that they're going to pay on dying with those assets. So it will certainly change how people take their assets and fund their income in retirement in the wider space, slightly less so with the NHS. But again, with the NHS, you now need to look at everything else that you've got and how that feeds into the inheritance tax, especially where you've got companies or you've got private pensions as well, because the huge liability now that have been added in are two big assets potentially that were previously excluded that no longer are. So we really need to be on top of this and how that's going to impact. I'm going to kind of whiz through the next bits, Tony, because I'm conscious that I've way ran over here. So a couple of other pointers that were on there: increased interest rate on late tax paid or late paid tax liabilities. That's gone up by 1.5%. Interesting move from HMRC. So anyone who's late paying their taxes, you now have to pay an extra 1.5%. No confirmation how that's going to relate across to the NHS. But could be a particular problem for GP partners where you estimate your profits and then correct your positions later on. Potential
I'm potentially going to be interesting with all the problems with admin at the moment as well, with pension taxation as well, and people needing to estimate.
Yeah.
If unless you had any other bits, I was going to switch over to my slide
Yeah.
then, because we're a bit over, so I'll try and catch up some time if I can. Just very quickly, just wanted to kind of just give a very basic overview of what pension is and what is pension tax. And I always say a pension is deferred pay. And the conversation I was having with Dan just before we started was, using pensions as an investment vehicle for inheritance tax really was never what a pension was meant to be. So I always thought those rules were a bit anomalous anyway. But we should see in the NHS a pension is basically part of our remuneration package and deferred pay. So we're not building up a pot. And so what they need to try and do is estimate the value of our pension, and that used to be on the left hand side here, the lifetime allowance. So they used to take our pension and times it by 20 plus the lump sum, so times it by 23 essentially. And if that was over, well, at its peak 1.8 million, you'd pay tax on anything that was over. That went down to 1.07, and then of course the LTA was abolished. Well, the charge went, and then it was fully abolished earlier this year. But then I think the bigger problem for medics has generally been the annual allowance, and the annual allowance is kind of how quickly you could fill this jug. So it's the kind of the deemed value of what your pension has gone up, and it started off at 255,000, and obviously at 255,000 no one had any problems filling a 1.8 litre jug, and no one paid either of those taxes. But then that went down to 50,000, and then 40,000, and then with tapering, and I'll talk about tapering in a second, down to 10, and then 4,000, and now it's back up to 60 with a minimum of 10 again. So I'm just going to spend a bit of time talking about the taper because it's really important for understanding what's going on with McLoud. So basically, the taper was intended that higher earners get a lower annual allowance, so they can contribute less towards their pension each year. And red is where it all started. So it used to be that you would have a standard allowance of 40, and then adjusted income is basically taxable income plus this deemed growth. And if that was above 150, that adjusted income, that would go all the way down to 10,000. And obviously completely impossible to fill a 1 litre jug with 10 mils a year in a tax efficient way. And so lots of lobbying by the BMA and others got that changed in the March 20 budget, and this is this orange line. So everything moved across by £90,000, but the sting in the tail was that it went all the way down to £4,000 or 4 mils for the very highest earners. And then this is the 2023 budget. So now the general allowance has gone up to 60, which means you've got this kind of longer downtick here, and now the minimum tapering is 10k. So the taper has changed quite a lot over the last few years, largely following action by medics, particularly refusing to do additional work, etc., because of tapering. And if Wes et al. Are listening, that's going to be a really big problem this year. And this is why. This is why. So I kind of stole the idea for this chart from a brilliant chart from the Institute for Fiscal Studies, and it was looking at loss of childcare allowances for people at the 100k tax cliff, and there's a very similar tax cliff, albeit at much higher taxable income of 200k. So what this shows is a member in year 13 who increments this year. And so that's actually me. So I became a year 14 consultant, only a month or so ago. So because of the impact of industrial action and the DDRB awards, despite inflation being quite high last year and the pension being able to go up by quite a large amount, because of the big growth from that partial pay restoration means you've got huge pension input amounts. And so that means that if we just look at post-tax earnings, that's this green line, that is really progressive. Yeah, so this is after the additional rate tax threshold. So you earn more, you pay more tax. That's completely fair and normal. Yeah, but this yellow line includes annual allowance, and you see that somebody falls off a cliff. And by falling off a cliff, just £1 extra earnings, so that's one more waiting list for Wes's waiting lists, and then they got an extra 22,500 charge. And so it means that you can be better off earning 199.9k than all the way up to 242.4k, which is just ridiculous. And then there's a similar kind of triangle on the other side of it. So whilst I think there was a bit of a sigh of relief for some aspects of the budget yesterday, in that there was no reintroduction of the lifetime allowance, and there was no flat rate relief. I think this is still a big problem, and it's a big problem this tax year in 24-25, and so it would be great to see if we can make some movement on that. So coming on to McLoud. So to understand what McLoud is, we need to kind of go back in history a little bit. So Lord Hutton was commissioned by the coalition government to look at our pensions because they were too expensive. Basically, we were living too long, and the cost of pensions were getting too high. So he was commissioned by the government, who just gone through a financial crash, to say do something about it. And so what he did about it was he recommended that rather than having a final salary pension, it was a career average pension, and that was particularly bad for medics, especially non-GPs, because obviously we do a lot of years as a junior doctor where our pay is much lower than our final salary. So consultants in particular did really badly out of that move. And the other thing that they did, because obviously the driving factor was people living longer, is rather than having a fixed pension age, they had a moving target, which was state pension age. And then there's also this horrendously complex thing called the cost cap. It's really important because the cost cap meant that the costs of these pensions would remain stable. So then it was fair both to workers and taxpayers, and because of that it came with a 25 years inverted commas guarantee. So the outcome of McLoud was that he basically, Lord Hutton said, don't give older members any protections, and government ignored that, and exactly as Hutton had warned, that would lead to age discrimination cases. And so there's a judge called McLeod and a firefighter called Sargent, and they won age discrimination cases in the courts, went to the highest courts in the lands, and because of that we have the remedy, and the remedy is on this kind of one page here. So I'm going to split it into two bits. So I'm going to start off at the end of your career and go to your retirement. So at retirement, everything after 2022, when the case was kind of all closed, is going to be in a new 2015 reformed care scheme. Everything before 2015 is going to be in your old legacy 95 or 08 scheme. And it's all about this bit in the middle. So there's this 7-year period. So when you retire, not now, you're going to have a choice whether you want that in the old bit or the new bit. And it sounds like a straightforward choice, but it really isn't. But the government also had to remove the discrimination now. And so that's what all these brown envelopes are about. Because for people with taxation charges, they've got to reassess these 7 years during the remedy. And that previous chart I showed you showed all the changes to the taper. It means there's loads of different tax regimens even within this 7-year period. We've also got, for members in England and Wales, a compensation scheme in 1920, and the 15-16 year was before tapering started, and that was split into too many tax years. So horrendously complicated. And the RPSS also includes 5 years before for carry forward. And because all of this took so long to sort out, AA was basically suspended for 22-23. So that year is also in your RPSS. So your RPSS includes 13 years of data. And obviously, normally, if you use an accountant, they're used to just dealing with, 1 active tax year rather than 8 active tax years and then 5 years. So it just means that the whole process is extraordinarily complex. And just to make it even more fun, they've made the deadlines for most people who've got an increased tax charge to pay, and lots of people will for the 22-23 tax year because that's never been assessed, the same deadline for the 23-24. So as well as sorting out these 13 years, you've also got to sort out the 23-24 tax year, which is via the normal business as usual process. Now there's also this kind of concept of in scope and out of scope. So normal tax law means that you can only make changes under self-assessment in the current year and the previous 4 years. And so that means that these 3 years in the remedy, 1920 to 21-22, are in scope. And that basically means if your charge goes up, you've got tax to pay. but if your charge goes down, you'll get a refund. These out of scope years would have meant that there was nothing that could be done, but obviously because the government discriminated against us, if you've got an out of scope claim, you'll still get compensation, but if your charge goes up, there's nothing that the government can do about it because it's out of scope. So why is your RPSS so important? And so we kind of label this trick or treat. I don't know whether Dan, were your one word for the budget was trick or treat. I think most people were probably a little bit relieved they didn't mess too much with pensions, but I think there's probably quite a few GPs on the call who are a little bit worried about, you know, things like employers NI and minimum wage, etc., and they just need some clarification as to what's going to go on there. But these brown envelopes potentially are a treat, because if you've paid tax charges, generally your growth is going to go down. And I follow one of the early YouTubes for a kind of fuller description of it, but there's three basic reasons why generally, but not always, charges are going to go down. The firstly is our pay was kind of trashed pretty badly in the 7 years of the remedy period. And so it's a combination of pay erosion, and so the fact that our pensions kind of went down in 1995 terms meant that 95 growth is going to be lower. There's obviously a difference in accrual between the two schemes. So the 2015 scheme, you get 1/54th of your pensionable pay each year, whereas the 1995 scheme, it's based on 80ths of your service at the end of your career. So, and that difference causes a very different growth rate, which is a bit ridiculous because it completely ignores the fact that one of them means you can draw your pension generally at 16. The other one, you know, for people like me, it's going to be closer to 68. So that's very unfair as well. And coming back to that kind of taper graph, the fact that 1 and 2 make your growth lower, because growth goes into the formula for tapering, it means that if you're subject to the taper, then the tapering is generally less severe as well. So, you know, for people that paid AA, and particularly for people that were tapered, generally they're going to be getting refunds. But you've got to remember a couple of things. Firstly, the 22-23 tax year hasn't been assessed, so that's not a case of it going down. It's like there are no figures to compare it to. So we've still got to sort out 22-23 as well as 23-24. But it can also be higher in some circumstances, and I've given a few examples here. So firstly, if you're a consultant psychiatrist with something called mental health officer status, that means that your 7 years in that period can potentially double up to 14 years. 2008 members are different maths to what's going on up here, because they get 60ths instead of 80ths, so it's obviously much closer to 54ths. But more importantly, it's based on this very complicated thing called reckonable pay. So rather than it being best of 3 for 1995, best of 3 last years, there's kind of an inflation adjusted 10-year look back in pay, which makes it much more difficult to predict. You know, and last but not least, obviously if you've had a pay rise and you've got more old legacy pension, which is based on your service, then you're going to have higher growth than you did before. But we kind of need to just remember this bit about out of scope and in scope. So we just kind of go back to this bit here. So if you've got a rise that's out of scope, then that won't cause a tax charge, but it's the ones that are in scope in these years here that you've potentially got a tax charge. And if you're a clinician in England and Wales in 1920, you'll be able to get that sorted through the compensation scheme. So I'm going to go over to a brown envelope cam, and I'm going to share my RPSS. So if you haven't already, you might want to go to that QR code or that link and download this triage on a page tool, and it just allows you to kind of go through your RPSS really quickly and see whether or not, firstly, you need to use the full tool, and if you need to use the full tool, it means you can get up to £1,000 Inc. VAT to pay for accountants to sort out this mess for you. So I'm just going to go to my RPSS that's been just redacted from addresses, etc. So a bit of bump at the beginning, just tells you what's in it and what's not in it, points out that your 22-23 PSS is in here, but your 23-24 pension savings statement will be sent separately, or in my case it won't be sent separately, because despite asking for it 3 times they've still not sent it to me. There's this kind of nice table that's on its side. Sorry, it doesn't project very well on this camera, but it just kind of splits all the new values and old values, and also the scheme pays settings. These kind of detailed pages aren't of much use apart from this kind of highlighted bit here. So if you look at your 15-16 closing value, this tells you what your pension was at the end of the 15-16 tax year. And because in the 1995 scheme, pension times 19 is that value, you can work out what your pension was. So basically, if this number here is above £826,087, which mine is nowhere near, you could still apply for something called IP16, which will increase your lifetime allowance. And obviously the lifetime allowance is gone, but it means that you can get a higher tax-free lump sum. Not a lot on that page. And then this is the money page, or at least this is the money page in England and Wales. And most of what you need is on this summary page. So if we just kind of go to my triage on a page, they're trying to basically make you ask 6 questions. Okay, so we'll just kind of go through them. So question 1, have you paid AA either via scheme pays or self-assessment? So the scheme pays bit is this red bit here. So you can see here for my numbers, I've had loads of scheme pays loans. So straight away I failed triage. That means I can get an accountant to sort this out for me, and the scheme will pay £1,000 Inc VAT to recompense the cost of that accountant. I've also paid some via self-assessment and cash or mixed. The scheme don't know about that, so that information is going to be on your tax returns, but most people will know if they've paid an AA charge. Question 2 only relates to annualised GPs. The actual question is something like, have your contributions changed? For everyone who's not an annualised GP, and if you were, the answer is no, so you can ignore that. Question 3 is any of your contributions higher in any year between 15-16 and 21-22. So you're just comparing the old values to the new values, and these values are combined with the legacy in the new scheme, because that's how they're asked for in the HMRC tool. So for example, for me, you can see all of mine have gone down. So 43, 36, 51 becomes 44, 37 becomes 13, and so on and so forth. So because all of mine have gone down, I don't fail on that question, but I wouldn't even be answering this question because I've already failed. So you only need to fail on one to be able to qualify for that assistance. Question 3, is your 22-23 growth above 40k? That's this yellow bit here. So you can see here my growth is 4287, so that's a fail for me. Question 5 is about your net income, and if that's above 190, then that's a fail. And you'll notice that they've put a bit of a buffer zone between threshold income of 200 and 190, and that's because they know that people have got this wrong in the past. So the actual tool will go through very detailed questions so that in the background they can work out what your actual threshold income is. So there was a great question on the last webinar I did. Could I make a retrospective gift aid donation to get myself below threshold income? And that's exactly the sort of thing that the HMRC calculator is trying to pick up, because they ask you about gift aid, because gift aid changes your marginal rate for paying tax, but it does not affect your threshold income. So that's exactly the sort of thing that that they're trying to detect, and it's exactly the reason why I would strongly advise you use a qualified accountant to do this. And question 6 is a kind of rarity. So if you've had a private pension, so not an NHS pension, that you've drawn since 2015, and if you've also contributed towards a private DC pension, again not your NHS pension, more than 4,000, that's capturing something called the money purchase annual allowance, but that's just not relevant to everyone else, so you can kind of ignore that. So why is all this important? Well, so if we kind of go over to my numbers again, for me this is going to lead to over £32,000 in compensation. So because I failed triage, because I've paid tax and this number's over 40k, I can get free accountancy and they can sort it out, and then the accountants can make sure that I get my £32,000 compensation. Now, I've used the word compensation loosely. The HMRC tool, it's got some slightly confusing terminology. So, for example, it'll say things like paying compensation to your scheme. Now, because I've had lots of scheme pays loans, so yes, they'll pay compensation to the scheme, but all that means is that the scheme pays loans will go down. The consequence of the scheme pays loans going down is that my benefits in retirement will go up. So it's all compensation to you, whether or not it's to you in cash with 8% interest, or whether or not it's to the scheme. So I was going the wrong way. So strongly advise you to print out that form. You can do that kind of triage bit on a page, or you can do it using the HMRC tool. If you get to this page, it's the bit that's telling you that you're going to the full tool, and I would strongly advise people to stop and get professional help at that point, and you qualify for being able to get the cost of that back up to £1,000 Inc. VAT. So you get your cost back through this thing, the cost claim back scheme, limited scheme to claim back costs, £1,000 for rollback for the cost of an accountant to use the HMRC digital service, and separately the consequence of going through the HMRC digital service is that you'll get your refund for any overpaid tax, and it's also the way to deal with any new charges, for example in the 22-23 tax year. So who are Forvis Mazars? They're a leading firm of accountants who are within ASMA, who are the Association of Specialist Medical Accountants, that cover over half of doctors in the UK. As you'll see from Dan, who's a financial planner on the call tonight, one of the reasons that I went with them is they combine both accountancy and financial planning, which is relatively rarer to have really strong departments in both, because I've not talked about something called contingent decisions, but whilst this RPSS process is kind of bread and butter accountancy work, if you need to decide things like, do you buy back pension, is it worth you spending X £1,000 to buy it back if you opted out, that's more of a financial planning question, and we don't know the rules around that whole process yet. So this is what the actual calculator looks like. It's sped up 20 or so times because it's horrendous. It's about 200 pages long. It's quite difficult to do it without getting things wrong, because apart from anything else you get tired. So the Forvis Mazars process is that you sign up to them, they will get all the data that they need from the revenue and the schemes, etc. Accountant one will check all over that and then feed it into the tool. The tool will tell them what compensation you're expecting. Then using robotic automation technology, that will complete the HMRC tool, and then a separate accountant, so a four-eyed check, will check that the HMRC output is as had been predicted and check over all the numbers again. And then if you're happy with that, that will be submitted to HMRC, and then you'll get your refund, and then sort out any additional tax if you've got new tax to pay, for example, in the 22-23 tax year. So for more info, you can scan that QR on the left. If you just want to go ahead and sign up, there's that QR on the right. Not wanting to worry anybody, but I think the whole sector is a little bit worried that capacity may be an issue. The deadlines are very tight. So particularly if you've got your RPSS, I would strongly advise people to find a provider early that can do this and register with them, because I think there's going to be an issue unless HMRC extend the deadlines, which lots of people have asked them to do. So kind of finally, before we just move on to a bit of Q&A, is what if you ignore it and what if you haven't received one? So don't ignore it. With kind of pension saving statements, I always told people, look, if you don't do this, no one's going to send you a bill, and under self-assessment rules, you're legally obliged to act on the information and work out whether or not you've got a charge, and then declare it and pay it through self-assessment or scheme pays. The RPSS analogy, kind of under this kind of trick or treat, so if it's a treat, the reverse analogy is no one's going to send you a check. So if you've overpaid your tax and the tax is going to change for everyone that's paid tax, then you've got to go through this process to access it. Deadlines are a bit complicated, but anybody that owes any tax, the deadline is going to be Jan 2025. It's different for people that have retired before October 23, etc. If you've not received an RPSS, it's 3 months from receiving one. If you haven't received one, if you're in England and Wales, I personally would be asking the scheme where it is. I would want to know whether or not it has been processed, and if so, they can email it to you. whether or not it's going to be in a queue for manual calculations. We know there were still thousands that are awaiting manual calculations, or particularly for GPs, whether or not they're not able to process it because they've got gaps in your record, courtesy of friends at Capita, because we know that there are very large numbers from Freedom of Information data that don't have complete records, and therefore the scheme aren't able to even commence the RPSS process. So I think, Dan, we will move over to questions. So I'm just going to change the view and have a drink and a cough. So I think my wife has been working diligently in the chat and has got some questions. So I will take the first one. So Daniel C says, "Hi Tony, probably been asked before, but is it possible for the RPSS to show I have a new charge rather than a refund, which seems to be the case for most?" So the answer is yes. So partly because, as I said, the RPSS includes the non-assessed 22-23 tax year. So no one has had that assessed previously. So if you were going to have a charge before, you're still going to have a charge now. Nothing's changed. That's outside the remedy. For people that are within the 7-year remedy period, as I said, there are some groups, including some in 2008, some with big pay rises, people with MHO that might still have a charge to pay. But for most, it's going to be a refund. This sounds like a planning question for you, Dan. 3 feet asks, if predicting to have taxable pay a little over 200k for this year, is a few weeks of unpaid parental leave a reasonable option to bring you down below 200k threshold and avoid the taper of AA? Any flaws? Or I guess the question is are there any alternate strategies, Dan?
Yeah, so ultimately, as I think 3 feet, you're onto the right kind of thinking, potentially. As you've just mentioned there, Tony, it might be that you choose gifted rather than pension contributions, but ultimately the aim of getting your threshold income below £200,000 is certainly a viable one at that point, to avoid the taper. I would say at that level, it's certainly worth sitting down and having a piece of advice on it. And you might expect me to say that, but genuinely, it's a very complex calculation and set of criteria to try and make sure that you hit the threshold test in the right way. So certainly, gifted or pension contributions may well do that. Unpaid leave is certainly naturally kind of probably an easier way of doing it, maybe. But again, you need to just be making sure that you're hitting the right numbers, because simple things like a little bit of interest on cash in the bank can accidentally push you over that threshold.
Yeah, so completely right. It's all about knowing your numbers. I did a video on this a couple of months ago that a colleague who was kind of maybe 10-15k over, and so gift aid only works if it's shares or property. Gift aid of cash doesn't reduce your threshold income, unfortunately. But the various kind of options that I looked at with my colleague who was in the situation, of all of the options, probably making a personal pension contribution into a SIP was the best of the options. So I know it sounds insane when you've kind of got a big pension tax charge and you're tapered to be buying more pension, because that obviously puts your pension growth up. But if you can offset the kind of loss of tapering by doing that, it's a great way of doing it.
Yeah.
So Jill asks, "Hi Tony and Dan, are the tools available to model various scenarios in terms of working patterns with respect to our pensions after McLoud, or should I seek advice, and if so, from whom?" So obviously I've done lots of kind of self use modelers in the past. I think for this whole McLoud situation, given the number of fields of data and the chance of making an error, we just felt it just wasn't doable within a self-service environment. And obviously in the context of RPSS, etc., you're able to get the costs of this covered using professional advice and accountants. So I would definitely advise people to go down that route, because it's a nightmare. But in terms of kind of modelling the future, Again, that's probably now is ultra specialist work,
Yeah.
and would generally kind of go to planners. There are going to be some tools that are coming out from the scheme that will allow people to look at McLeod, and I've kind of fed back to kind of in confidence about early versions of that. It's definitely not there yet, and I've suggested quite kind of major improvements. So for example, it only uses your current pay and ignores any potential future promotional pay, which I think is is very challenging. If people, if you're a consultant who's kind of mid career and know what the rest of your career structure is going to be, then you need to model that in terms of what your future pension is going to be. So I've made some recommendations, and so hopefully there's going to be something coming from the scheme. I've also asked if the scheme can pre-fill it, so rather than asking you to enter a load of data, we're in 2024, the scheme hold a lot of data on you. My view is that the scheme should be able to pre-fill all of those modelists for you, and give you some estimate. Dan, have you got anything to add on that one?
Yeah, I think we've seen people try and do this, and what generally is the output is that you get kind of, well, if you do this working pattern, you'll earn this, your pension will be worth this, and if you do this, it'll be worth this, and if you do this, it'll be worth this. So you kind of get three numbers. But we've been at Forbes Mazars, we've been doing it for a number of years, and a big part of what we do then is ultimately, despite all the complexities, it's just a pension. And what we then try and do is how do we bring those numbers to life? And that depends on personal circumstances. What do you spend? What do you live off? What do you want to do? What means, what's important to you and your family? And that's stuff that any kind of tool and modeler can't give. And I think that's where it crosses. If you just want to know the numbers, that's where the tools and the what you'll get from the calculators will be fine. But if you want to bring all of that to life and actually kind of come out with an outcome of, well, what does it mean, and what can I afford to do that still allows me to do the things that I want to do? I think that's where it crosses into the realm of you need to seek advice. As I say, that's something that we do, but there's other financial advisors out there as well, that are able to offer that service. But I do think that's where it crosses over into, ultimately where you start to think about, okay, what I really do need to consider getting some advice at this point.
Yeah, so Paul C asks, hi Tony Dan, I've had my RPSS sent to me but not yet had a 23-24 PSS. Should I be asking the NHS Pensions Agency for it? How can I complete my 2023-24 tax return without it? You and me both, Paul. So I've had my RPSS. I've asked 3 times for my 23-24 pension savings statement, given that we're past the statutory deadline. I've not even had the courtesy of response, sadly, on that particular element. I have raised this with government. I have pointed out to government that my accountant is charging me an extra £200 for getting the data late to them. And in fact, I had an email from my accountant today saying that if I didn't have all my data to them by Monday, they wouldn't be able to do my self-assessment this year. So I do think it's a complete disgrace that the scheme is saying things like there are no timescales for this, and we don't even have a plan when we're sending the data. Other schemes are in a different place. So Northern Ireland, they've got a portal. The 23-24 growth's already all in there. I was promised by the head of pensions back in 2020 that we would have all of this in a portal by June 2020. And obviously COVID put things back a bit, but I think there are serious concerns about pensions tax administration in the NHS BSA, and it's causing people a lot of stress, and I'm sure it's causing accountants a lot of stress as well, because they're all super busy helping people with RPSSs, but then they can't do their self-assessment without a pension saving statement. So I've obviously able to estimate my figures more accurately than most, and so I've told my accountant what my estimates are and said, but I've not been able to do it definitively because the scheme haven't provided the figures. But the law is you're expected to estimate it, which is a bit of a joke, I think, because last year they suspended the 22-23 AA reporting because people couldn't estimate it because they, hadn't sorted out what was happening in the remedy period. So you really need your RPSS and your 23-24 PSS to do this properly. I think Paul asked the question that we just answered. Predicted staff taxable pay just over 200, despite dropping all extra work. Is taking a sip of 5 to 10 reasonable to get below the cliff edge? Even that means an excess bill. 100% yes. Definitely take Dan's advice on. You really need to try and calculate your. Pardon me. Really need to try and calculate your taxable pay really accurately, because there'd be nothing more annoying than taking out a SIP of 10k and then ending up with threshold income of 200,006 pence because you forgot bank interest or something like that. So maybe even put in a margin of error in there. So another question from Paul. Dan, you might want to take this. Do they compensate the interest on scheme pays loans where the RPSS McLeod reworking shows refunds due? I might be able to answer this in more detail, but have a stab, Dan.
Yeah, I was going to say, Tony, I think my understanding is that obviously the scheme pays from the process and from the tool that we have, the scheme pays will be amended back with NHS pensions. And naturally, because the NHS pensions are the ones that have paid that tax charge, the refund will be back due. The refund on the interest on the scheme pays will be due back to the NHS and not to you individually.
Yeah, it's essentially right, but it's a slightly different mechanism. So basically, NHS BSA in England and Wales don't calculate your interest until you retire. So there's no need to make a correction for interest. So for the cash refunds, they will pay 8% interest. For scheme pays, because interest hasn't been applied yet, there's no need to make a correction for interest. So you're in no worse off position. Yeah. So 3 Feet says, if you get scheme pays compensation to reduce scheme pays, we also get the extra 8% off scheme pays loan. So no, because there's no need. So that reminds me, and I've got a terrible cough. Dan, whilst I go and cough and turn my mic off for a second, in the last call, and I can't remember the name of the person on the YouTube, but they said, can you give an example of a scheme pays loan? So for example, if you're kind of mid-40s, got a 10k loan, how is that going to affect your pension? And I said I could estimate it off the top of my head, but it'll be wrong. So I decline that. So I'll pass that over to you whilst I turn my mic off and cough for a minute.
Yeah, that's fine. Yeah, so we ran the numbers on this one, Tony, before we came on the call. And ultimately, if we look at a £10,000 annual allowance tax charge at age 45, assuming a 2.4% interest rate through to retirement, so just a kind of standard interest rate through to retirement, 15 years, all in the 1995 scheme. By the time you retire at age 60, that scheme pays £10,000 will be worth £20,000 926. So that's the debt to the scheme, including the interest that's charged. And what that actually equates to in a worked example that I've got here, £10,000 tax charge results in your pension at age 60 being reduced by £832 per annum. Now that's gross. So £10,000, 15 years, reduces down £832 per annum. Now, if you're a 40% taxpayer, assuming at that level you will be a 40% taxpayer, that works out at around about £499 net loss to your income. And if you put that down into a monthly figure, £41.60 worse off per month in retirement because of that £10,000 tax charge at age 45. So £10,000 at age 45, interest accrues, divide it all down, £41.60 less in your bank per month in retirement.
Yeah, and obviously there's kind of some caveats to all these calculations that no one knows what the interest rate's going to be, and the interest rate is got 2 components. So there's CPI, which is kind of the standard rate of inflation. There's also something called SCAPE, which is basically kind of based on government estimates of long-term growth. And so both of those things come into factor. And then There's another factor, which is the reduction factors themselves, and they change every 4 years with evaluation cycle. So no one can give you an absolute definitive answer because there's kind of various moving parts. Justin D, do we have any time frames on RPSS? I'm still waiting. We know a lot of people are still waiting. In England and Wales, we're told that 57 odd thousand have gone out, but there's still probably tens of thousands that don't, particularly GPs. Just in comments, contacting pensions generator generic, we have no time frame reply. I've expressed concerns to the scheme and to government that is not an acceptable answer. Kelly, if a mistake in RPSS and you are in process of getting it sorted out, time frame unknown as payroll and pension teams are slow, how long will the window be open to correct to HMRC? So it'll be 3 months after the corrected RPSS. So it'll be like you've not received the RPSS at all. Pardon me. So Kelly, how do you apply for 1920 scheme pays? Has the scheme officially reopened? So all of that, so if Forvis Mazars are doing it, all of the scheme pays loans will be dealt with by them. And so a lot of it's going to happen in the background between HMRC and the schemes. And if there's any forms required, those will be produced automatically for you to sign. When we set up the compensation scheme, we explicitly said that it needed to stay open for this because we knew that some people would have issues that needed to be sorted out. Sally, being 45 past retirement before the date of 24/5 pension output will presumably drop the value of 95 scheme growth due to mitigate the 145 AA growth for 24/5 if I do nothing. Not sure I understand that question.
I think. Sorry, I might be wrong. I'm just thinking. I think what Sally's saying is she wants to ultimately take partial retirement to stop her growth, to ultimately take her pension now and stop the calculation of pension growth, because ultimately she's not paying into the scheme. So effectively take the pension rather than accrue the pension, which I've been asked this question quite a few times on what's best. And I think the important point to start with is the £145,000 is a tax on growth. And because you've got that level of tax charge, and I assume by that you mean tax charge of a not that's your input. If that's your tax charge, it's quite a significant jump that your pension's just received. I mean, it's a massive jump that your pension just received. Let's not underplay that. But in that case, would you stop that growth just for the point of avoiding the tax charge? Well, you will still be better off in retirement by accepting the growth and funding the tax charge, probably through scheme pays. Let's be honest, at that level. But I'm always conscious of people who I wouldn't say be totally put off by the number that's that's going on the tax form. Still think about, actually, is that good pension growth that will help me?
Completely agree. So I mean, assuming you've got a number for 24/25, someone's predicted that number for you, because obviously 24/25 isn't closed yet, and those figures won't be out for a long time. But Dan's absolutely right. If you've got very large growth, you've got very large growth because your pension's gone up quite a lot. And the bit you've got to remember is that you've got to be contributing to the scheme and earning the higher amount for it to be in your final salary pension. So, my personal example, I just got my year 14 award in my September payslip, and then in my October payslip I got the DDRB with back pay. And so, I mean, I'm nowhere near retirement, but if I wanted to kind of burn that into my final salary pension, I would have to be working for 365 days after that date to get the effect of that. They don't just say what was your final salary on the date you retire. It's based on what your last 12 months contribution history were. So completely agree with Dan. Almost certainly the best thing to do is just take it on the nose, and schemes pay it. And because you're 55, that example that Dan gave was someone who I think was 45.
Yeah.
So that's 15 years interest. At 55, your interest is going to be a lot lower because you're closer to retirement, and so you've kind of got to offset all the moving things of early retirement factors, how your salary is going to change, interest, etc. It all goes into the mix. So hopefully that answers your question. And I think that might be the last question that I can see on here. So I think probably all that remains is to thank everyone for your questions. Thank Dan for his time. If people are interested and they want another view, as I said, one of the reasons that I went with Mazars is because they have both accountancy and planning. So Dan is given the view of a financial planner, and so they're kind of more about kind of forward-looking decisions. But on Saturday, I'm going to be joined by Alex, who's another colleague from Mazars, who's one of the directors, who's a specialist medical accountant. And so his worldview will be from an accountancy point of view, and probably much more about what's happening kind of now and this tax year. And I suspect because of the budget and GPs and stuff, there's going to be quite a bit of a focus on that as well. So please feel free to come along and join us. And as I said, if you want more information on my partnership with Mazars, there's QR on the left. If you just want to go ahead and sign up, it's the QR on the right. So thank you very much for your time. Cheers all.